There's a formula. Annual expenses multiplied by 25. That is your retirement number, not a vague $1 million, not a projection a financial advisor showed you on a chart with a smiling couple on a beach, a mathematically derived target that tells you to the dollar when you can stop working. And here's what they do not tell you up front. That number also reveals exactly how many years away you are. If you have never calculated it, every investing decision you are making right now is essentially a guess dressed up as a plan. The median American, aged 55 to 64, the cohort on the literal doorstep of retirement, has $185,000 saved. The median for all working-age Americans with any savings at all is $87,000. Their FI number, the amount they actually need to retire on a $60,000 a year lifestyle, is $1,500,000. That is a gap of more than $1,300,000. And the terrifying part is not the gap. The terrifying part is that most of them have never run this calculation, so they do not know the gap exists. They have a feeling about retirement, not a number. 2/3 of Americans say the United States faces a retirement crisis. I would argue the crisis is less about money than about math. People are not failing to save because they are lazy. They are failing to save at the right rate because they have never calculated what the right rate is. So, here is what this video is. I am going to show you the one calculation that converts "someday I'll retire" into a specific date with a specific dollar sign attached. Then, I am going to show you why the conventional advice, max your 401k, wait until 65, trust the process, is designed for a world where you work until your body gives out, not a world where you make a deliberate choice. And then I am going to show you 2 mechanisms that will quietly destroy your retirement even after you hit your number. Mechanisms that most retirement calculators hide behind their default settings. This is not a motivational talk. This is arithmetic. Let's go. Think of your retirement savings as runway. An airplane does not need infinite fuel. It needs enough fuel to reach a specific destination. Most people are building fuel without a flight plan. They know they should be saving. They are pouring fuel into the tank, but the runway has no designated takeoff point, no destination in the nav system. They keep fueling and never know if they are ready. The FI number, your financial independence number, is the moment you know exactly how long the runway needs to be. The moment you calculate it, everything else becomes a logistics problem. How fast can I build this runway? What is eating into my runway budget? Am I accounting for crosswinds? Here is the formula. Take what you actually spend in a year, not what you think you spend, what you actually spend. We will come back to this distinction because it matters enormously. Multiply that number by 25. That is your FI number. That is the total invested portfolio that could, under historical market conditions, fund your lifestyle indefinitely. The 4% rule, derived from research by William Bengen in 1994 and expanded by the Trinity study, found that a portfolio invested in a mix of stocks and bonds could sustain 4% annual withdrawals for at least 30 years across nearly every historical scenario. 1 divided by 0.04 equals 25. That is where the formula comes from. It is not arbitrary. Recognizing that some retirees are too reluctant to spend down their principal, Bengen himself adjusted his recommendation for a first-year withdrawal rate of 4.7%, as outlined in his 2025 book, A Richer Retirement. According to Morningstar's latest analysis, the base case safe withdrawal rate for a 30-year period is 3.9% for a balanced portfolio with 30 to 50% equities. So the real answer is somewhere in that corridor, call it between 3.9 and 4.7%. For planning purposes, I use 4% and 25 times expenses. Conservative enough that almost every historical scenario survives. Simple enough that you can actually calculate it tonight. Spend $60,000 a year. FI number is 1 million. 500,000. Spend 80,000. 2 million. Spend 100,000. 2 million. 500,000. Most people have never sat down and done this math. And until you do, the runway has no endpoint. You keep building and never know if you are ready to take off. In a few minutes, I am going to show you something that will completely change how you think about the accumulation phase. It involves a table that most financial advisors do not put in front of clients because it makes their services look considerably less necessary. But first, let me show you why the conventional retirement playbook treats the wrong variable as the main character. Every piece of mainstream financial advice centers on one thing: earn more, higher income, faster retirement. Of course it sounds right. If you earn more and invest more, you get there faster. That part is true. But here is the reversal. Your income does not determine when you retire. Your savings rate does. The percentage of your income you save may be the single biggest determinant of when you can retire. The higher the percentage of income you save, the sooner you will be able to retire. And that is not just because you are saving more, but because you are spending less too. Think about what that means mechanically. Your savings rate is a single number that does two things to your retirement timeline simultaneously. First, a higher savings rate means more money going into your portfolio every month, which means your runway fills up faster. Second, a higher savings rate means you are living on less, which means your FI number just got smaller because your FI number is 25 times your annual spending. Cut your spending, cut your target. Here is what the math actually shows. At a 7% return, assuming you start from nothing, save 10% of your income 41 years until retirement. Save 20% 30 years, save 30% 24 years, save 40% 19 years, save 50% 15 years. Save 60% just over 11 years. Pause on those numbers. At a 10% savings rate, you are on a 4-decade road trip. At 50%, you are out in 15 years. The same income, the same market, completely different runway lengths. The only thing that changed was how much runway you stopped burning. Here is the psychological trap that keeps this table from changing behavior. People hear save 50% of your income and they think that is impossible. It sounds like deprivation, but deprivation is a frame. A person earning $120,000 a year and spending $60,000 is not deprived. They are, by most global standards, living extraordinarily well. They are also retiring in 15 years. The person earning the same income and spending $90,000, the one with the bigger house and the nicer car and the annual European vacation, is retiring in 30. That is 15 years of freedom exchanged for a Porsche lease and a kitchen renovation. I ran a business for over 10 years. I was surrounded by accountants and fiscal lawyers who showed me how money actually moves at a systemic level. And the pattern I watched repeat itself among successful people, not struggling ones, was lifestyle creep absorbing every raise, every bonus, every windfall. The income went up, the spending went up faster, the savings rate stayed flat, and the retirement date never moved. Every dollar cut from annual expenses reduces your FI number by 25 times. This is the highest leverage move available. Not market returns, not fund selection, not any investment strategy. The spending audit, running the double compression, reducing expenses to both lower the target and increase the savings rate simultaneously, is the most powerful mechanism in personal finance and the least frequently discussed one. Because it is boring, it cannot be sold as a product, and it requires you to confront what you actually value rather than what you assumed you valued. By the way, hit subscribe if you like the content, otherwise the algorithm may never surface this to you again. And we are about to get to the part that might actually be the most useful thing in this video. Most people assume the hard part of retirement planning is getting to the FI number. They think accumulation is the whole problem. They are not wrong that it is hard. They are catastrophically wrong that it is the main problem. Here is the number that ought to make everyone stop. American retirees think those who want to retire comfortably in 2026 need an average of $823,800 in savings and investments. Currently, retirees have an average of just $288,700, socked away barely a third of the amount they feel new retirees require. That is not a planning gap. That is a reality gap. The magic number Americans think they need to retire comfortably in 2026 is $1.46 million. And yet, the average retirement savings for all families is $333,940, and the median is $87,000. Only 5% of households with retirement accounts have $1 million or more saved. 5%, 1 in 20. The rest are either still building or have quietly stopped believing the math applies to them. Here is a story that sits in this gap. There was a couple, I heard this through an advisor I know, who retired in their early 60s. They had what they believed was a complete plan. They had tracked their spending loosely for years and estimated they lived on about $65,000 annually. Their portfolio was $1.6 million. At their spending number, their FI number was $1.6 million. They figured they were at parity, they retired. Their first full year of actual retirement spending, $89,000. Not because they went on a spending spree, because the $65,000 was a memory, not a measurement. It did not include the full cost of their cars, or the irregular home repairs, or the dental work that showed up that year, or the gradual inflation in their grocery bill, or the fact that with time on their hands, they were eating at restaurants more, traveling more, spending more. The $89,000 was the truth. The $65,000 was a feeling. Their real FI number was $2,250,000. They had retired with a $650,000 deficit, disguised as a balanced ledger. They made it work, eventually, by adjusting spending and doing some part-time consulting. But the adjustment was painful and unplanned, and it happened because nobody had ever made them calculate their actual number from actual data. You think the problem is getting to the number, but actually, the problem is knowing what the number is. There is a gap, and it is not just about savings balance. Here's the part that never makes it into a standard retirement calculator. Knowing your FI number and having a system built around it are two very different things. I spent the last 2 years going through 50 years of actual retirement data, not opinions, not projections, and I distilled what matters into a digital book called The Exit Code. 8 chapters of research, no filler, no motivation section, no 5-minute chapter that tells you to believe in yourself. It does not include that. One chapter covers what I call the invisible bill, the healthcare insurance gap for anyone who stops working before age 65. We are going to talk about the surface level of that in this video, but the full calculation mechanics and the gap account strategy are in the book. Another section covers a tool I call the dynamic withdrawal method, which is what actually replaces the static 4% rule when you need to survive the market conditions of your first decade of retirement without selling equities at the bottom of a crash to pay your utility bill. The exit from the rat race is a mathematical event, not an emotional one. The exit code gives you that math in one place, structured as a framework, not a collection of blog posts and footnotes. It is less than the cost of one dinner out, and you can access it through the link in the description below. If you are serious about knowing your actual number, not your felt number, this is the next logical step after this video. Now, back to the mechanics, because we just talked about the accumulation side, the getting to the number side, and that is only half the problem. Here is the reversal. You can hit your FI number 1.5 million, 2 million, whatever your target is, and still run out of money in your late 70s. Not because the 4% rule is broken, not because you invested in something wrong, because of the sequence in which the market decides to return your money. This is sequence of returns risk, and it is the most underappreciated mechanism in all of retirement planning. Pattern interrupt coming. Ready? 2 people, identical portfolios, identical FI numbers, identical withdrawal rates, same average returns over 30 years. One retires and the market goes up 22% in year 1. The other retires and the market falls 37% in year 1, which is exactly what happened to anyone who retired in 2008. 2 retirees have the same starting portfolio, the same average investment return, and the same withdrawal rate. One runs out of money at 82. The other dies with 1.2 million. The only difference? The order in which they experienced market returns. Same runway, same fuel load, different weather at takeoff. An alternate scenario starts with the negative 37% returns of the 2008 market crash happening in the very first year, bringing the balance down by $370,000 in a single year. As you can see, the owner of the second account runs out of money by year 17 simply because they encountered a down market much earlier in retirement. Here's why this happens mechanically. The sequence risk is particularly destructive because withdrawals interact with market declines. If you start retirement with $1 million and expect to withdraw $40,000 a year, a 4% withdrawal rate, and the market falls 20%, your portfolio immediately falls to $800,000. Now you are withdrawing $40,000 from $800,000. That is a 5% withdrawal rate. More shares sold at depressed prices. Fewer shares to participate in the recovery. The math does not catch up, it falls further behind. The danger zone for sequence risk is the first 5 to 10 years of retirement. A major bear market during this window, combined with ongoing withdrawals, can reduce your portfolio to a level from which it mathematically cannot recover regardless of subsequent strong returns. A 30% crash when you have $50,000 invested costs you $15,000. That same crash when you have $1.2 million invested costs you $360,000. Literally 4 or 5 years of retirement income gone in months. That is the crosswind at rotation speed. That is the moment the runway that looked sufficient suddenly was not. Morningstar's 2025 research found that retirees who experienced poor returns in the first 5 years and did not adjust their spending were far more likely to go broke. The mitigation for sequence risk is not a better stock picker. It is structural. One approach is to maintain a short-term reserve of low-risk liquid investments that you can use to cover your expenses while you avoid tapping your stocks. Keeping a year's worth of expenses in cash investments and another 2 to 4 years worth of expenses in high-quality short-term bonds or short-term bond funds creates a buffer. You spend the buffer when the market is down. You do not sell equities at the bottom. You wait for recovery and replenish. The portfolio survives. This is the practical implication of knowing your FI number. It is not enough to hit the number. You need to build a buffer into the architecture before you go wheels up. Now, there is a Marcus in this story. Marcus is 53, good saver, 20 years in the same industry. He has $800,000 in his 401k and about $50,000 in a taxable brokerage. His informal plan, the one he discussed with his wife, the one that felt solid, was to retire at 60. His number, he figured, was around 1.2 million. He was roughly 2 years ahead of schedule. He felt good. His company announced a restructuring. Marcus was offered a package, take the buyout or take a demotion. He took the package. He is 53. His timeline compressed by 7 years. A 2024 report from the Transamerica Center for Retirement Studies found that nearly 3 out of 5 retirees left the workforce sooner than they expected. According to a recent Edward Jones study, 40% of their clients were forced into retirement. Workers continue to report an expected median retirement age of 65, while retirees say they actually retired at a median age of 62. The gap between when people plan to retire and when they actually retire is on average 3 years. And those 3 years are not free. They are 3 years of reduced Social Security benefit, 3 years of missing portfolio growth, and this is the part that lives rent-free in my head, 3 years of private health insurance before Medicare exists. High rates can have a big impact on your budget if you retire early and have to pay full price for insurance. For the 3 years, from age 62 through 64, you could pay a total of $62,340 for health insurance after your monthly bills are added together. That is $62,000 in premiums, before deductibles, before copays. Before the prescriptions that seem to multiply around 60 in the way streaming services multiplied around 2015. And that is assuming you qualify for subsidized marketplace coverage. At the end of 2025, the enhanced premium tax credits that had lowered ACA premiums since 2021 expired and were not renewed for 2026. For early retirees, this means the subsidy cliff at 400% of the federal poverty line is back. So anyone earning above roughly $62,600 as a single person pays full price for marketplace coverage, which can exceed $1,500 a month at age 62 in some rating areas. A couple retiring at 62, both paying full price, over $124,000 in premiums in 3 years. Not healthcare expenses, premiums alone. The actual costs add deductibles and out-of-pocket maximums on top of that. According to Fidelity Investments' 2025 retiree healthcare cost estimate, the average 65-year-old who retired in 2025 will spend an average of $172,500 on healthcare and medical expenses throughout retirement, not including long-term care costs. That is the Medicare covered portion. The pre-Medicare gap is a separate problem, the gap account. That is what I call it. A separate taxable brokerage account, open now, labeled specifically for pre-Medicare insurance costs. Not part of your FI portfolio, not counted in your FI number. Earmarked for the gap years. Marcus, our 53-year-old with $800,000 who just got handed a package, now faces not just a compressed timeline, but a 12-year insurance gap before Medicare eligibility. Even at a conservative $800 a month, well below what full-price marketplace coverage actually costs at $60, that is nearly $115,000 before Medicare kicks in. His original FI number of $1.2 million did not include that. His real FI number, accounting for the insurance gap, a 2-year sequence of returns buffer in cash and short-term bonds, and his actual spending after running a real expense audit is closer to $1.7 million. He thought he was almost there. The real runway was still $500,000 longer. Somewhere right now, there is a financial advisor who told Marcus his plan looked great, then handed him a brochure for a variable annuity with a 12-year surrender period, then started charging him 1% of assets annually for the privilege of that conversation. That 1% matters more than it sounds. At a 4% withdrawal rate in retirement, a 1% advisory fee represents 25% of your annual retirement spending. The fee accounts for $1 of every $4 you withdraw, 1% of assets, 25% of your annual income in retirement. Most people hear 1% and think it sounds small because it is designed to sound small. An investor places $100,000 in a fund earning 7% gross annually. The gap between 0.1% and 1% at year 10 is roughly $15,800. By year 20, it has grown to approximately $59,100. By year 30, it reaches $165,800 on a $500,000 starting balance over 20 years. The cost of that 1% fee versus a low-cost index fund is roughly $330,000 in lost compounding. Without fees, the portfolio grows to approximately $1.93 million. With a 1% fee, it reaches approximately $1.6 million, $330,000 of runway, quietly built and then quietly burned because the fee was expressed as a percentage of something you did not see eroding. The system works perfectly. For the advisor, most actively managed high-fee funds are economically unjustifiable when historical data show that almost nobody beats the market over multi-decade time periods. Index funds through Vanguard, Fidelity, or Schwab with expense ratios under 0.10% eliminate the fee structure that destroys long-term returns. Now, I want to show you what all of this looks like when it runs together in a real scenario, because the math is not abstract. Sarah is 41. She earns $90,000 a year. She currently saves $1,500 a month, about 20% of her take-home pay, split between her 401k and a Roth IRA. She has $150,000 in invested assets. Her plan, such as it is, has always been to retire around 65. She has never calculated her FI number. Step 1, figure out what she actually spends. Sarah pulls 90 days of bank and credit card statements, adds up the real numbers, and discovers she spends $72,000 a year, not $60,000, which was her assumption, because she had never added up the vacations, the car payments, the dining tabs, the 10 streaming services she is subscribed to, the irregular expenses she always mentally categorized as one time, but which appear every year. 72,000. Her FI number at that spending level, 72,000, multiplied by 25 equals $1,800,000. She has $150,000. The runway is very long. At her current savings rate of 20%, and a 7% average annual return, she hits 1,800,000 in approximately 30 years. She retires at 71. Then she does two things. She runs the expense audit seriously. She identifies $11,000 in annual spending. She does not actually value subscriptions. She forgot she had a car payment on a vehicle she is planning to pay off in 2 years and not replace, dining out patterns that are habit rather than pleasure. She cuts annual spending to $61,000. Her FI number drops to $1,525,000. Her monthly savings increase because the same income now has less expense competition. Her savings rate climbs to roughly 28%. At 28% savings rate, starting with $150,000, targeting $1,525,000. At 7% average returns, she hits the number in approximately 24 years. She retires at 65. Now the third variable. She opens a separate taxable brokerage account and calls it the Healthcare Bridge. She puts $300 a month into it in a conservative mix of short and intermediate bond funds. At a 5% return, by the time she is 65, that account holds approximately $122,000. That covers roughly 3 years of full-price marketplace insurance premiums and out-of-pocket costs before Medicare. That money sits outside her FI portfolio. It does not affect her FI number, but it means that when she retires at 65, she is not drawing from her invested portfolio to cover the pre-Medicare gap. Without the gap account, she would either need to increase her FI number by $120,000, pushing the target higher and the retirement date later, or she would retire at 65 and start spending down her FI portfolio to pay insurance premiums during the first 3 years of the fragile decade, the sequence of returns window, the worst possible time. Her actual outcome with all three moves: retirement at 65, on a specific date she can calculate now with a math-based architecture rather than an optimistic assumption. Compare to her original trajectory: retirement at 71 without an insurance bridge, with a spending number she had never verified and an FI number she had never calculated. That is a 6-year difference in freedom, not produced by earning more, not produced by picking better stocks, produced by knowing the formula and applying it in the right order. Now let's close out Marcus's story, because Marcus is not left stranded. Marcus, at 53, with $800,000, just got forced out on a timeline he did not choose. His real FI number is $1.7 million. He is $900,000 short on a compressed clock. But here is what changes the moment you have a number. Marcus knows precisely what he needs. He can model part-time consulting income and calculate how many years of that income it takes to close the gap without drawing from the portfolio. He can see that 3 years of consulting at $70,000 a year, invested entirely, gets him to within $300,000 of his target by 56. He knows he needs a 12-year healthcare bridge, a larger gap account than Sarah's, because his runway to Medicare is longer. He can calculate what monthly contribution closes that specific gap. Marcus's plan is not comfortable, but it is specific, and specific is solvable. Many workers are not prepared financially to retire 10 years earlier than planned, and on average, it takes 2 years from time of application to receive Social Security disability benefits, during which time the individual cannot work. The people who get destroyed by a forced early exit are not the people with the wrong portfolio. They are the people who never calculated their number, who never built the gap account, who never thought of sequence risk until the market was already moving against them. The runway that was never marked, the fuel that was never measured, the crosswind nobody planned for. Here's the closing. 3 things, specific to everything we covered, not generic. First, tonight, not this week, tonight pull 90 days of bank and credit card statements and calculate what you actually spend per year. Multiply by 25. That is your FI number. Write it down somewhere. You will see it. If the number is uncomfortable, good. An uncomfortable number you know about is infinitely more useful than a comfortable feeling you have never verified. The calculation takes 90 minutes. It has a 6-figure impact on your financial outcome. Second, run the double compression. Take that annual spending number and ask, where is $11,000 to $15,000 of spending that I do not actually value? Not spending I want to eliminate as a sacrifice. Spending I would not miss if it were gone. Subscriptions I forgot about. Habits I call enjoyment, but that are really just defaults. If you cut $15,000 from annual spending, your FI number drops by $375,000 and your savings rate increases simultaneously. That double compression is the closest thing to a financial cheat code that exists, and it costs you nothing but a Saturday afternoon and some honesty about your credit card statements. Third, open the Gap account now. If there's any meaningful chance you might stop working before age 65 voluntarily or not, because nearly 3 out of 5 retirees leave sooner than they planned. You need a dedicated account outside your FI portfolio, earmarked specifically for pre-Medicare insurance costs. At a minimum, model 3 years of coverage at $12,000 a year per person. For a couple, that is $72,000 you need to have parked somewhere before you consider retiring. If you have a partner and you are both 52 years old, you need that money building right now. Not at 61 when the math is too compressed to close the gap. The FI number is not a destination. It is an engineering specification. The runway has a calculable length. You just need to run the calculation. Lazy investing built more fortune than crypto memes. And the people who are going to retire broke, most of them had a plan. They had a feeling, an intention, a contribution. They auto-drafted every month. They just never had a number. And a number is the only thing that separates someday from a date on a calendar.